Jim, I'll start with you. How do you think about how much more upside the stock can have, given it's already, 100% run over the last 12 months?
Well, you're correct. And if we look at the fundamentals about demand of what's happening with Apple, here's some dynamics that are very interesting. Some of their products, such as AirPods as well as Watch, are selling out. That's a great indicator for demand. And it's not because they're having issues with production or yield issues. It's simply demand is so strong. We see this year revenues growing about, 10, 11%, and earnings growing 20, 21%. And then we believe in April, they're going to announce another capital deployment of increasing the stock buyback and dividend. So we think estimates keep going higher. The company keeps making more money, and margins are also going higher. It's setting up for a very good opportunity and a reason why we think people should buy and own Apple stock.
You're not worried, Jim, at all about the uncertainty around the coronavirus and the supply chain?
Well, we're definitely keeping an eye on it. To completely say we're not worried would not be true. I am definitely concerned about it and watching it. Tim Cook did mention that they're building in a little more conservatism around the virus. We're carefully watching it. We hope that the people who are smarter in the medical field really get their arms around this and contain it sooner rather than later. We're watching it. But right now, fundamentally, Apple's end markets in every region and every product are seeing great demand trends.
Krish, what's your take on what drives the stock from here?
Yeah, I do agree with a lot of what Jim said. I think the three things from my vantage point is, number one, I think the iPhone momentum is still there, especially as you head into a 5G cycle. And what you have seen over the last 6 months is iPhone units get revised upwards. So I think that momentum definitely helps the stock. And the services is still holding up pretty well. I understand the bear argument, which is maybe nitpicking a little bit, but concerns over valuation that services kind of came in slightly below consensus. But the reality is that you have a $50+ billion revenue business growing at, mid to high teens growth rate, which is pretty impressive. And then the third thing I'd also highlight is that I understand that December is seasonally the strongest quarter, but the free cash flow margin is almost 28%. And all the buyback Apple has done over the last 6 to 8 quarters has been funded by cash flow. And, Luca, the CFO, has spoken about being net cash neutral for 2 years now, but they still have $100 billion plus in net cash. So I think the dynamics are still in favor of the stock and biased to the upside.
Yeah, I'm glad, Krish, you mentioned that bear case. We did have Dan Niles on yesterday, runs a hedge fund, has jumped in and out of Apple. He's been short, he's been long. He was saying he was actually looking at today as an opportunity to potentially go short. He didn't like the $300 million miss on the quarter for services, said that if you're going to value this stock higher, which has been the whole thesis over the last year, a higher valuation on services, you can't miss on that kind of growth. How do you push back against that?
Yeah, that's why I said, it's a little bit of nitpicking on one end because you missed by $300 million. It's roughly a 3% downside versus where consensus was. And the second thing is these are consensus numbers, not management guidance. But the flip side of the argument is I do understand the bear argument because part of the whole services thesis is that it helps re-rate the multiple for the stock, and that's kind of what has happened. So I do understand that argument, but I would probably say that taking one quarter and a $300 million miss on a $12.7 billion revenue and extrapolating it, I think is is being a little too aggressive. I would probably say look at the bigger picture, look at the trends. Here you have a $50 billion revenue business growing still a high teens CAGR, so I think that's respectable. And what surprised people to the upside on the services was the margins, which is still a healthy 64%.
Hey, Jim, I'm curious about your view long-term about the number of shares outstanding and buybacks. And you look at the peak back in 2012 and the degree to which it's come down since. Do you think there's more to go in terms of removal of the float?
We do. When we look at Apple's capital deployment program, they've been very consistent with returning cash to shareholders in the method of two things. First, a stock buyback, and second, a dividend. We expect when the March quarter ends and they announce earnings in April that they will announce another stock buyback of about $75 billion, as well as increase the dividend by 10%. So those two metrics we believe are going to return cash to shareholders because Apple is generating traditionally a ballpark around $70 billion of cash per year, and they eventually want to get to net cash neutral which, as Krish said, that, again, he's absolutely correct on his numbers, that they have a lot of net cash that they can still deploy, in addition to additional M&A in a tuck-in area. So we expect another stock buyback of $75 billion, and that's going to help reduce the share count and drive earnings in addition to the sales and margin expansion.